Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers. Chances are you've shopped at a Mr. DIY. Mr. DIY is the most popular home improvement chain store in Malaysia. There are over 1,000 Mr. DIY stores nationwide and is set to open 180 new stores in Malaysia by the end of 2023. But Malaysia isn't Mr. DIY's only market, however. It has stores in Singapore, Thailand, Brunei, Indonesia, Philippines, Cambodia, India, Turkey, and Spain, making it an increasingly global rather than local brand. Since going public in October 2020, Mr. DIY has even launched two new subsidiary brands, Mr. Toy and Mr. Dollar. So welcome back to Stock Investing from Zero on WangHiro. While we love shopping at Mr. DIY, is it a company we should invest in? So John, what should a beginner look at when thinking if they should invest in Mr. DIY?
Most of the time, when you hear Peter Lynch, he says if you love the store or the business, most likely you like the business as well. But that is just at the surface level. I know a lot of people love going to Mr. DIY to shop because it's cheap. I go there at least once a week.
Oh,
There's definitely something that I'll buy.
true.
Yeah,
They've gone way out of like only home improvement. They even have like little snacks in there nowadays.
correct.
Like
Yeah,
competing with supermarkets in general.
correct. Usually the snacks they have is a long shelf life one, lah. Like seaweed, biscuits. Yeah. They won't buy the perishables, because I
Correct.
don't think that's
Like no vegetables or anything like that.
correct. Yeah, but usually that's why I go there every week because my son will want some kind of junk food. Now he does. Kind of think of it, I haven't bought a toy for him in almost 6 months, which is good. So I used to go there and buy toys because it's cheap. It's like probably at least 50% cheaper than a toy store, right? And toys for kids usually they don't
remember their toys.
Yeah, they don't remember their toys, and you've got a collection of here and there, right? The second reason why I go there is because it has everything in one place. So if I want to buy stationaries, I want to buy like electrical, like DIY home improvement stuff, like a plug, battery, all that kind of thing. Everything is there. But at the same time, we have to be aware sometimes as a consumer, while we like it, it's convenient, does it really make money? And that's where it boils back to the 4 questions again. What do they do and how do they make money? Are they profitable, financially stable at doing what they do? Who's their audience? How big can they grow? And last but not least, are they cheap and expensive? So as you rightly pointed out, 1,000 stores nationwide, set to open 180, expanding into Philippines, Cambodia, around the region, I put it this way. Now,
then even outside of the region, actually.
Spain is definitely outside of the region. Turkey is also definitely outside of the region. Now, are there local guys competing there? I'm very sure there is. I think from my point of view, I think the only competitive advantage they have is how well they manage their procurement system, inventory system. Because for me, if you don't manage your working capital and inventory well, that's where you end up with holding cost. Because for them, you think about it, your margins are kind of thin, in a way. Kind of thin.
Quite.
Yeah. So we're going to go through that. So what do is they try to stock up, inventorize, and operationalize a platform to sell hardware, daily consumable goods and DIY stuff. Okay, so let's look at their numbers now. Are they profitable doing it? Let me share my screen because I was just looking at the quarterlies last night, Louis. They kind of topped out at about $1 billion a year already. So the past few quarters, the sales per quarter is roughly about $1 billion. It's not very seasonal. It's like, before the podcast, we were discussing some businesses, they are very seasonal in nature. But I don't think DIY is seasonal because it's like the everyday store. Yeah, it's the DIY.
And I don't think they run like big campaign promotions or anything like that.
No, not really.
It's like an everyday discount store.
Yeah.
Can't go lower than that.
Yeah. So over the past 2.84 years, CAGR return of 7.4%. Actually, not bad. Okay, let's look at the financials. Okay, I'm going to plot it out. It looks like it's increasing, right? But the last few quarters is just 1B. It's stagnating already from the quarterly perspective. Okay. Operating margins have been coming down. I don't know if you noticed that. Gross margins still maintain roughly the same or coming down a little bit. Okay. Operating margins coming down. Okay, net margins. Let's look at net margins. Yeah. So you're talking about 17% to 11% kind of decrease. Actually quite decent for a discount store, to be honest. Right? So in terms of profitability, is profitable, definitely profitable. Net income is here. Operating cash flow, go to cash flow statement. Yeah, it's growing. Cash flow is growing. Okay. In tandem with the rise in revenue. Okay. So profitable wise, financially stable, they're there. What about balance sheet? Do they owe a lot of people money or not? Okay. Cash about 180 million. Yes. Let me close all of this. Okay. Cash about 200 million, December 2022. Total liabilities about, wow. Okay. So cash in hand, 202 million. What they owe people, suppliers, loans, long term, whatever, is about 1.8 lah. It's quite a lot. To be fair, we shouldn't benchmark just total liabilities. We should maybe just benchmark their debt. So I'm going to take this off. Benchmark their debt, which is here, long term debt, and then portion of short term borrowings. Okay. Yeah. So their cash is definitely much bigger than their long term and short term borrowings. What I think contributes to the liability is the biggest chunk is actually a lot of it is, I think, their working capital. Current portion of lease, okay, that's high. Now, I know I may be gibbering here, but there has been a new accounting standard, Louis, that even if you rent the premise, it has to be parked as a debt that you owe.
Oh.
In the past, before MFR, this is a new standard called MFRS 16, Malaysian Financial Reporting System. It's an accounting standard. Before MFRS 16 was introduced, a lot of your long-term rental obligations are not parked as debt on your balance sheet. Because technically you don't owe them money. You can just run away, right?
Yeah.
Right? But a lot of companies were hiding a lot of this debt behind the scenes. So what they do now is the accountants are forcing companies, let's just say you, like Padini, you sign a long-term lease with, let's just say, Mid Valley. That obligation of your capital, your what we call your rental, is actually parked on the balance sheet now as your capital lease obligation. Because you already parked in. Technically, you have to pay rental over the next 5 years
liable
already.
to pay that.
Yes. Even though you may not need to pay today, but it's actually a long term.
That makes sense. Yeah.
So that's why it's a bit high. You see the liabilities is high. The capital leases are also so very high. Because I don't think they own most of their stores, because a lot of it is in malls and all that. So that kind of prepayment or that kind of recognition of that liability is there. Yeah. So in terms of cash management, actually not bad, to be honest. I've not looked at the numbers recently, but yeah, it's interesting to look at it. The quarterly report, this is where I was mentioning, Louis, because if you look at it, Q1 2022.
Sorry, just a bit bigger. Cannot see.
Sure.
Yeah.
Definitely. Okay.
Okay.
See, Q1 2022, right? It was 1.04 billion. This quarter two 2022, Q2 2022 is also 1.09 billion. So actually, they have not really grown, Yeah, even though they open new stores, they've increased their probably about 50 million only. Yeah, but it also explains because their ticket items are very small.
Yeah.
Okay. Yeah. The other thing that I want to look at in terms of profitability, just a quick one, is actually if you read the annual report, what I was interested to see is what is their basket size and what are the things that people buy from Mr. DIY. So if you look at it, you've got household and furnishing. It's roughly about 39, 38%. So kind of like stabilized. Hardware, 17%. Electrical items, 10%. Stationery and sports. This is quite interesting. Others is they lump everything. I think they're snack, maybe your car accessories and all that kind of thing. Household furnishing is still one of the highest contributors. And I don't think they break it down to you what is the profit margin for SKU. I think it's quite difficult also. But what they're trying to focus on, which is right. Actually, Tesco does this. It's what we call house brands.
House brands, I
You
see.
keep on creating house brands because you are such a big buyer. You don't actually need to buy a Philip light bulb anymore. It's a Mr. DIY light bulb. And I tell you why. When they were listed, about to go listing, they were the largest seller of Philip light bulb in Malaysia. So
Oh.
instead of like relying on the Philip brand name, because when you rely on a brand name, you're expecting them to do marketing, distribution, all that kind of thing, right? Marketing lah, brand name, right? We do distribution. But why, if I already have the distribution network, why should I need to go back to Philip? I have to pay Philip the royalty, the brand, all that kind of thing, right? I just go to the contract manufacturer. Hey, can you make a bulb like Philip, but put it under my brand? That's where you get to charge that kind of margin. You see, that's where house brands. That is what is the aim of a house brand. You see, the house brand is like so you can incur the higher margins. Yeah, that's why I want to look down. I wanted to look more detail at their breakdown of each of their SKUs to be able to see what's their goal moving forward. In a way. Yeah. Oh, this Mr. DIY Express.
There's also like Mr. DIY Plus, I think.
Which is the right way to grow, to be honest. Which is the right way to grow. Yeah. So who's the audience? How big can they grow? Obviously, the everyday Malaysian. I mean, like, I haven't seen foot traffic. A quick glance. I haven't seen foot traffic data here. How many new customers? How many? I don't think it's easy to keep track anyway.
Yeah, it's very hard.
It's
Very,
very
offline business. Right?
Yeah, it's a very It would be fantastic if they do like a membership kind of thing. Then they'll see how often the clients come back and all that. But I don't know whether clients are willing to divulge that kind of privacy for a very low ticket item. Or an Apple product, something more higher price maybe. But for a low ticket item, a bit of a question mark, right? Okay. Next question. Are they cheap or expensive? Okay. Audience size, valuation size. So let's look at the valuation that I have today. Okay, it's come down by quite a bit. At the peak, there were like 64 times PE next 12 months or forward. If you go down to like the trailing, which is here. Yeah. At a high, they were like 44 times. Okay, let me zoom in a bit. Over here. Can you see here? Here, Louis, on the top. Over here. So this is actually a band. This is actually a band of the price to earnings multiple of the share price. So the higher the number, let's simplify it, the higher the number, that means the more expensive the valuation is. The lower the number, the cheaper it is. So what I try to do is when I put in a band like this, I'm trying to find where's the median. Where's it in between? So the peak, as you can see, right? The peak was early days when they got listed 40 times. Okay, 40 times. You went all the way until about 60 times, 64 times at the peak. Okay. And then at the bottom here, right now, is roughly about 21 times, which is like, I would say reasonable, but still pretty expensive. So if you want to benchmark, right, you have to find a Mr. DIY equivalent kind of business in maybe a different country, and then you do the benchmarking lah. So if you were to look at the US, maybe a Home Depot, but Home Depot is so much bigger than where they are lah. I mean, Home Depot, you literally can buy an entire wood to build your own house,
Wow.
Yeah, if you go Google Home Depot, you can buy planks to actually build your house. Home Depot in the US. So
I feel like even though like Mr. DIY is home improvement, it doesn't cover everything yet.
Everything.
Yeah, it's not everything.
And it's okay. You know why, Louis? We don't have a DIY culture in Malaysia. I don't know if you know.
That's true. That's true.
You go to the US, people build their own bookshelves, people build their own house. A lot of them no carpentry skills. But in Malaysia, because labor is so cheap, you realize that? Labor is so cheap, you don't repair your own pipes. You don't I know of guys like 40, 50 years, they don't know how to replace a light bulb.
Wow. So they have to hire someone to get.
Correct. And it's cheap here. In the US, it's so expensive. In Australia, it's so expensive. That's why you think of it from that perspective. Like you want to hire a plumber, it's so expensive. So because of that, then you have to learn the skills to DIY yourself. And that's why like Home Depot would fit into a cultural nuance of that lah. That's how I see it lah.
That's interesting. I mean, in terms of like the market, like okay, yes, we see like everyday Malaysians. I'm just thinking like they're so aggressive in going overseas, right? Is it because that they're seeing some saturation locally? Domestically, are we
I think so. I mean, like you go like even you
1,000 stores?
yeah, it's 1,000 stores. With roughly about 33 million population, but
In
very
Miri alone, I think we have 5 or 6 stores already.
yeah. So
A
you
very
just imagine,
small place, yeah.
Miri,
300,000+ people only.
yeah. So you see, for average Mirians, you've got if you got 6 stores for 300,000, so every 50,000 you've got
Yeah,
one DIY.
yeah.
Yeah.
Like literally, I can like 5 minutes away from my house. There's one. It's like in every even the most like like there's this one mall that's empty.
Mm.
So Mr. DIY inside.
Wow.
Yeah.
Yeah.
I just don't get that. But yeah, there's so many Mr. DIYs to cover everyone.
I think they have an advantage because they are taking over a lot of mom and pop hardware stores.
But at the same time, I feel like the quality that they offer is quite different.
Definitely. It's
right?
the lowest end,
Yeah,
something
yeah.
that won't
Like
last you long.
they don't they I mean at least for the DIYs I see here, they don't have Stanley hardware.
Yeah.
They don't have that, and that's like I think mid-tier quality stuff that you can find in like the mom and pop stores easily.
Correct.
Not that expensive as well, right? Even I see them in supermarkets, but not in Mr. DIY.
Yeah.
Yeah, they're quite focused on the very, very low, like 100 plus ringgit, kind of like Stanley's 300, about half of that.
Yes.
They don't have that. So
yeah, actually you kind of think of it, I hardly see something in Mr. DIY that's like more than 100 ringgit. Very rare. Very rare.
I think to say that maybe they're replacing not quite, right? Not really. Not really. So I'm just thinking like they've reached a point of saturation in terms of a certain specific segment that is willing to
They want
spend.
it cheap, they want it convenient, and but
not necessarily the best quality. Yeah.
Correct. Yeah. Do you have any other questions? Or
yeah. So there's another question. Like we have like one very interesting thing I found, like which was quite true with another company we cover, which was Arista, is that there's a 51% ownership of Mr. DIY by one private company. And then 13% of Mr. DIY is held by insiders. And then investors, like retail investors like us, only make up 17%.
Yeah.
So a big concern, at least in Arista, even though they have a 51%, it was like divided between 7 companies.
Yeah.
In Mr. DIY, it's just one company, B Family Limited.
Yeah. So that actually impacts what we call market liquidity. Even though you may be, let me see what's their market cap today. Market cap is about 14 billion. They should be on the index soon. They should be, if not on the index, they should be on the index soon. Because Inari just fell off. Inari was about 11 billion in the market cap, so they're 14 billion. So I think they should be on the KLCI index. It does impact market liquidity because usually for a main board listed company, free float, that means the amount of shares that's available to everyone, public market should be at least 25%. That's the listing rule. So in a way, maybe they managed to circumnavigate that because, like, you see, even the Tan family, the Tan family has a lot of individual stakes there. Yeah. You've got BlackRock, you've got JP Morgan, you've got like then you've got like Urus Harta, and you've got the Vanguard Group, right? Public Mutual is also there. I think for the retail investor, for a company this size, 17%, let's use 20%. 20% of 17 billion, still quite sizable to be honest. But obviously, the majority shareholders can still screw with you lah, if they want to lah, because they remain in control. And I think, Louis, you raised a very good question about Arista Networks comparing this to Malaysia. You know, like Jeff Bezos of Amazon, even though he's like a multi-billionaire, he only owns like 7% or 12%. I can't remember. Very, very low. Because
I remember for Nvidia was like 3%, 3 point something.
Yeah, Jensen himself, right?
Yeah, Jensen, yeah.
Because you dilute, you got institutional shareholders, whatever. Yes, are they subject to a hostile takeover potential? Definitely. But I think in Malaysia, they're so afraid that they hoard onto everything that in a way, if they are benevolent and they really want to grow the company, fantastic for shareholders. You trust the family, they have minority shareholder in mind that they want to grow. But on the flip side, because they control so much and very little public float, right? they can do whatever they want, and minority shareholders, no matter how much you want to protest, also doesn't make a difference. So I'm not saying that they're bad. I'm just saying that
Right. There is that risk. I think
yes,
that
there is that risk.
that is a risk that's just lying around there.
Correct.
So another thing is around dividends, right? So in the
Mm.
last couple of years, this dividend has been quite low, and recently they're saying, okay, it's gonna be increased by 31%, so from 61 cents per share to 8 cents.
Oh,
Sorry,
it's
6 point.
0.0061.
Correct.
Yeah.
Correct. Yeah. Per share, right? It's per share.
Per share basis.
Yeah, correct. To 0.08. So is this something like, okay, if someone wants to just invest based on this, like, oh, it's gonna be a dividend stock?
No, definitely not.
Oh,
The way to look at a dividend is this, Louis. You look at what we call a dividend payout ratio. So dividend payout ratio is just the amount of dividend being paid divided against the net profit of the company. Because as a shareholder, the only way you can receive income from the company is actually through dividends. And the payout ratio will dictate that, hey, how much profit you make, how much of it is being given back to the shareholders. So like not last year, 2019, I think this was the year they listed, or maybe, yeah, they paid out
2020. Yeah.
2020, right? So in 2019, they actually paid out 157%. So that means that they made a profit of, let me see, 317 million. The payout was higher than that, probably about 400 million. They pay out as a dividend to shareholders. 2020, they paid out about 28%. And then last year, they paid about 43%. So that means they may have a dividend policy guidance. Most companies in Malaysia don't like to give guidance, right? But if they keep this up, that means whatever profit that they're making, they're paying you as a shareholder about 40%. So look at that rather than look at the percent basis, because on a percent basis, right? But not even you don't even relate it to how much profit they make. You don't have a good clue of. Yeah, don't look on a percent basis.
Whether is it fair
yeah.
to, yeah, okay.
Yeah,
Or is it an income from dividend kind of stock, right?
Correct.
Okay. I think that sums up the analysis around Mr. DIY. So let's go to the last section, which is the investing book.
Yes.
Yeah. So what's the investing book you recommend for beginners today, John?
Okay, good. I'm going to promote a local author today.
Oh, interesting. That's the first one.
Okay. Yeah. So we talk about all the greats in the US and whatever.
Yeah,
Let's promote some local authors, okay? Good friend of mine, Ng Zuhan. He goes by the nickname of TradeView.
Okay. I used to follow him when he was actively blogging. Now he doesn't.
Yeah, because right now he has, because of rules, he owns an asset management company now, so he still writes on newspapers though.
That's
and
great.
He has a column. Okay, so actually the title of the book is Once Upon a Time in Bursa. Let me try to bring it up. For you so you can actually have a look at it.
I'll definitely get this book. I'm a big fan of his work. Yeah.
Yeah, and in his book, credit to him, he actually spoke about. What do you call it? Analysts, sell-side analysts that he actually respected in Malaysia, and that analyst I happened to interview in my podcast before also. Yeah, so I don't want to spoil too much of. It's an okay read. It's not that difficult. It's quite easy read as well, and I don't want to reveal too much because a lot of it is there's stories about companies in there.
Wow, that's interesting.
Yeah, the story. So a few companies covered there will be people like QL, the QL group.
Yes, I know he was a big fan. He was the one who called it.
Yeah.
The time that the Family Mart came into Malaysia, he was like, oh, QL is very cheap, etc. Yeah, very.
Today
very
they're expensive. 50,
yeah,
50,
back
60
then,
times PE.
that was like Zuhan called it. Yeah.
Yeah. So there's also companies. There's also fraudulent companies that he called out. And she's quite recent because the book was written, I think, 2019, 2020. No, I can't remember when. I actually gave him a forward for the second edition. Yeah, but what's interesting is instead of just showcasing the good companies, he actually showcased examples of how companies can actually misdirect investors. I think the word I would like to use. He will share with you examples of how this misdirection happens. and hopefully investors can actually learn from all this misdirection and all that lah. Because
Very interesting.
this misdirection, it's like this particular company, and then all of a sudden they'll tell you, I'll do this, I'll do this, I'll do this, but never execute on the business plan. And then they'll raise money from investors because they sell them the story. And then after that, you get stuck. Not only you get stuck, you get diluted. Because every time you raise money, what happens? When you raise money, you're actually raising your common equity, which actually dilutes the existing shareholders. And they are very well at playing what we call this capital exercises. And like every time we hear bonus shares, actually it's not good. It makes no difference. It makes no difference. Every time I see private placement, I'm very, very wary, because private placement is given to a selected few people, because only people with money and shareholders that have it. And that's where, it may not be of the best interest of minority shareholders who may not be able to afford it. So he does describe this in a little bit, not in very, very much detail, because I think if
I'm very excited to read it. I didn't know that he actually published a book. So
okay.
very rare.
So Zuhan, shout out to you. You see, you have a fan here. Right?
I'm a fan, but it's just like after that, I guess probably after he started the asset management company, he stopped blogging.
Yeah.
I used to subscribe to his Telegram. Yeah. A very big fan. It's just after that he stopped doing a lot of that stuff. So now I think he's very focused on the rest of his work. Very, very good. So I'm definitely getting this book to have a read. I love his writing.
I maybe if I meet him up for another lunch, I may get an autograph. So don't buy first. Get an autograph.
Get an autograph for me. Yes.
Yeah. So the title of the book, Once Upon a Time in Bursa. The publisher is someone we also know, Louis, a good friend of ours.
Oh yeah, John. John.
Yeah, it's John as well.
To John too.
Yeah, shout out to John too.
Sometimes he watches our videos, right?
Yeah, he sometimes I know sometimes he does, sometimes he don't, but I have said this in his face many times, Louis. I said, I have to thank you because you're the only publisher that publishes local financial content, which is good content for everyone. I mean, he's been pushing us both to write books on our own, but we have failed.
Don't worry, John. It's coming.
It's coming, John. It's coming. Okay, from both of us. All right. So yeah, that's the book that we have for this week. Once Upon a Time in Bursa.
Thank you so much, John, for recommending this. It's a very good find, even for me. I love all the books that you recommend so far. They're gonna fill up my whole shelf. Okay. So to our audience out there, did you enjoy our analysis of Mr. DIY? Are you an investor? If you are, then maybe share your insights on why you are invested or are you pulling out. Okay, so do share all your insights there. Or if you have any questions around what John has done here in terms of the financial stuff, some of them are quite deep, so you can go in. The tool he uses is Ticker, so we'll have include the description, the link in the description below. So if you enjoy analysis like this, then make sure to subscribe to our channel, and especially this video, give it a thumbs up to help us with the YouTube algorithm. We'll see you again on our next episode of WangHiro. Bye bye.